Hello everybody, I'm Mitch DeWitt and I'm a financial advisor at Walkner, Condon Financial Advisors. I'm also a CFP, or Certified Financial Planner. We're going to continue this little mini-series on different forms of equity compensation. So again, as a reminder, that is something that is part of your compensation package through your employer. So stock options are something that can be offered as part of your compensation package. And the ones we're going to talk about today are different than standardized options contracts that you might speculatively invest in or protect a long position that you own through your brokerage account. That's one thing. This conversation is focused on what you might receive as part of your pay. The two main flavors of stock options that come from your employer could be ESOs or NSOs. ISO stands for incentive stock option, while as NSO is non-qualified stock option, or sometimes you might see NQSO. And there are some differences between the two as far as who they might be available to, but the big difference is going to be on taxation, and we'll hit a little bit on that later. But in either case, they are options. Options meaning they are granted to you, but you don't actually own the underlying shares. You have the option to exercise, if it makes sense, at some point in the future at a given price that's established by the grant that's given to you. When it comes to taxation, that's where we see a lot of the differences between the ISOs and the NSOs. Generally speaking, ISOs can be more favorable from a taxation perspective because more of a potential gain could be subject to capital gains rates, which generally are more favorable than ordinary income rates. On the non-qualified stock option, the NSO side, that's where there's a little bit of compensation income, which would be ordinary income, and then a portion, if sold, if you actually take the shares of the stock that you own and sell them later at a capital gain, that portion could be at a capital gains rate. So we're not going to get into all the weeds here. Again, I'm not a legal tax advisor, but the different events where some taxation might occur are different between the two. So for example, when an option is granted to you, in either case, ISO or NSO, you're not going to experience a taxable event. So at grant, no tax. Beyond that, you'll have the option to exercise at some point, if it's vested, right? So vesting is another point between grant and exercise. So it's granted, after a certain period of time usually is when that option might vest, which you're then able to exercise. In a lot of cases, at vesting, no taxable event. However, when it comes to exercise, in the case of an ISO, that's where an AMT adjustment might come into play. So work with your tax advisor for the potential ramifications of what that might be. But ultimately, when you sell the stock that was acquired through one of these stock options, that's where most of the taxation will usually occur. There's something called a qualified disposition versus a disqualified disposition. So in the case of an ISO, there's two things that need to be met in order to be a qualified disposition. One is that it has to be 2 years after that option was granted to you, and then 1 year after you actually own the stock, so when you exercise the stock and receive that share of the stock. Both of those conditions need to be met in order to capitalize, no pun intended, on the capital gains treatment on the sale of the stock. Again, this can be in the weeds from a tax perspective. It's one of those things that our job is to bring it into the total picture on how this fits into your financial plan and strategy. Of course, these are things that you want to run by your tax advisor along the way as well. If ISOs or NSOs are part of your equity compensation, please reach out. We'd love to have a conversation with you.